Is there more downside risk for stocks? Let's find out in part one of the Sunday Chart Show, where we look at the S&P 500, Nasdaq 100, Russell 2000, and junk bonds. I'm your host, Steven Van Metre, and thanks for joining me today. Let's kick this off with the S&P 500. We're going to look at a breadth indicator, the percentage of S&P 500 stocks above their 50-day moving average. And remember, when stocks are above their 50-day moving average, considered bullish. When they're below it, it's considered bearish. So you're looking for the trend. And right now, only 43% of the S&P 500 stocks are above their 50-day moving average, and that's sliding down. We talked about this last week, how the risk is this is going to come back down to the 40% level. It's almost there, sitting at 43, potentially even heading back now down to the lows, just under 30. And from a technical perspective, that puts your baseline somewhere around 4,200 for the S&P 500 to test. And we mentioned it was headed lower, and sure enough, it is. Now let's zoom out to the percentage of S&P 500 stocks above their 200-day moving average, because when it's over, when a stock is over its 200-day moving average, it's considered to be in a bull market. When it's below, it's considered in a bear market. So looking at the index, you see 44% are above their 200-day moving average, and that's sliding, looking weaker. And what we can tell based on the previous slide is the 50-day moving average for a lot of these stocks is below their 200-day moving average, and there wasn't a lot of push here. So you're seeing a bear market, perhaps a little bit of a bull market run in a broader bear market that's building here. Look for this potentially to get back down to 40%, and again bring the whole index down with it. From a broader perspective, would it be unusual to see the breadth on the 200-day moving average pull back that much as we look at the historics? No, we can see perhaps maybe we're getting a situation here in the 90s where there's just a bit of a recession, and you're going to see a pullback as it starts to fight higher before it surges up. Well, we'll see soon enough. How about the relative strength indicator? And of course, this is a momentum indicator. When it's above 40, that means momentum is positive. Below 40, that means momentum is slowing. 30 is oversold, and it looks like the S&P 500 is headed down, so potentially due to the RSI, it's got more downside here to come. How about the MACD, the moving average convergence divergence? I know I like to say crossover because, well, that's really what you're looking for, is the crossover of the MACD line, the black line against the signal line, the red line. And what you're seeing here is that MACD line heading lower, suggesting, again, more downside risk for the S&P 500, a retest perhaps of that 4,200 level. And how about Momentum Time Pro that now actually has a guidebook? I know you're surprised. You thought it never would happen. Well, if you haven't signed up, or maybe you have in the past but unsubscribed, if you sign back up, I'll put a link in the corner, and when you get your report on Monday, there's a guidebook. So what this tells us on these sell signals is it looks at the RSI over 40. It's looking for the MACD with a positive cross and its own internal sell signal to be positive. If two of those three are good, then you get a buy signal. So right now, Momentum Timer Pro has been saying for the last 8 trading days, sell. When we look at the longer term signals of 1, 3, and 6 months, you notice it's got a mid strength, a minimum strength, a mid strength. And what it's telling us is that the S&P 500 isn't decisively in an uptrend or a downtrend at this point. So if you're trading a short term move when the sell signal flips to buy, keep it to the short side, because, well, that's kind of what it says at the moment. Let's zoom out to the bigger picture. We know the moving averages are trending lower. See the 21-day, 50-day, 100-day, all bearish, all heading lower. Momentum to the downside. It has slipped below all the moving averages, which it was holding there above some of them last week. Momentum has turned negative. So broadly speaking, we're looking at potentially a lower S&P 500 here. Let's take a look at the volume profile. Now, if you're using your charts, all you have to do is go find the volume profile setting, and what it will do is it'll tell you where all the volume's been trading over the last period of time that you select. So right now we're on a 1-year chart. We're going to use SPY, and we can see that there's heavy volume here right around 440 over the last 12 months. And you'll notice on Friday, boy, the sellers came in and just drove this down. So what that's telling you is up here, this is a supply zone, sell zone. This was a buy zone, and these buyers now are turning into sellers, driving price down. Here's your next supply zone for SPY. Is sitting just around 420 or a bit below, suggesting there's some more downside risk here. if this line fails to hold, now we can go out to the 2-year chart, and I want you to see that most of the shares traded in the last 2 years, if you can believe that, are right where it was on Friday. If that is an indication that more selling is coming and this zone flips, well, now you've got some real downside move to 390. But notice the moving averages are rolling over. The 100-day is turning down. The 50-day is lower. On the 21 days curling and heading back down. The 200-day has been acting as resistance. So right now, this is bearish. Are we in a bear market? Well, maybe a bit too early to call, but maybe not far off. All right, let's head on to the Nasdaq 100. Look at the percentage of Nasdaq 100 stocks above their 50-day moving average, a mere 30%. So clearly there is a bearish trend in the tech area. And we kind of mentioned that could be possible with it getting down to this 30% range and perhaps needing to hold there, or it faces a deeper sell-off to fall perhaps down to the 20% level or lower, where it's found buying support in the past, as we can see where buyers came in as it saw weakness in the breadth indicator there. Now let's zoom out to the 200-day moving average, and boy, we could see that tech stocks are in a bear market. In fact, only 28% of them are in a bull market that are above their 200-day moving average. This looking like it's going to come down into the 25%, maybe even down in the 20% range. And that is a critical task for the Nasdaq because it needs to hold support at right around 13,000. How about from a broader picture? Is a pullback in the cards? Yeah, absolutely. We've seen these sell-offs, we've seen counter rallies, and then the breath gives up and it tries at it again and gives up until all those sellers are worked out, and then it moves higher. So, look at this and say, yeah, tech stocks could go lower. How about the relative strength indicator? It's at 36. Momentum is slowing, looking like it's going to head down to the 30 range, perhaps get to overbought. And for those who are bullish, well, they're hoping it gets there before it hits 13,000 or right around that mark. How about the MACD? We have a negative crossover to the downside. It's looking like it's headed lower. So again, more downside risk for the Nasdaq 100 Momentum Timer Pro. Now notice here, I want to point out that here you have the 1-month strength indicator at minimum, the 3-month at none, and the 6-month at minimum. So it's telling you it's in a downtrend. So the way you would read this is if there is a sell signal one day and then you flip to a buy, which would give you a signal perhaps to take a short-term trade. In a downtrending market, you want to keep it short. Maybe a 1 day, 2, 3, maybe no more than 5, but you want to keep your stops tight on those trades. That's how you can interpret the report, which you'll learn more about in the guidebook available on Monday. How about price on the moving averages? We know they're heading lower, momentum to the downside, below all the key moving averages. Everything through 9-month momentum is negative and falling. All those are not good trends. Let's head over to the volume profile. Let's look at QQQ. Hope we get a better picture, and the answer is we don't. You can see right here where the supply zone is between these two purple lines, right at 365. What do you see here? Sellers. Now remember, this was a buy zone. Went up here, found sellers, buyers flip, and then it crashed down into this supply zone, which was briefly, it's been breached a couple of times, but buyers keep coming in. Now, where does it tell us? That we're looking at a 320, maybe down here into 315, 316 for the Nasdaq. And let's zoom out to the 2-year chart. Again, look at this heavy selling. So, it almost tells you perhaps we are in a broader topping pattern, perhaps too early to call, because look at all the support here, right around 316. A lot of buyers sitting here. So if that holds, look for another rally off of this. But if it doesn't, if it breaks that, now you can kind of almost say we're about to say we're in a bear market, and then you've got your next level of support down here around 293. Notice again the 50-day moving average trending lower. We have a cross to the downside of it, rejection to the bottom of it. That's a bearish trend. The 200-day moving average is flipping into resistance. That is a bearish trend. The 100-day moving average cross downside, and what is it? Hitting the bottom of it and getting rejected. So this, from a chart perspective, not pretty at all. All right, let's go on to the Russell 2000. Maybe small caps will give us some hope because small caps tend to lead the large caps. In this case, from a technical perspective, looking at price right around 1950, small caps could be on the cliff of doom. And here we see a mere 27% of them are above their 50-day moving average. So most of them momentum to the downside, heading lower. That is bearish, looking like it's going to come back down to this 20% range again. That's where buyers have been pretty consistently. We can see that here in January, see that here again in late February, and then finally buyers won out and push it up, but that is a bearish trend. How about overall? I'm talking about being in a bear market. A mere 25% of the Russell 2000 holds above its 200-day moving average. That is dangerous, mega bearish, and look at where this could go. I mean, we haven't seen too many instances from a historical perspective when it breaks below 25%, but when it does, now you're talking almost none of the Russell 2000 being above its 200-day moving average, and there's your massive buying opportunity. Could signal a huge sell-off in the Russell 2000. How about the RSI? Broke 40 to the downside. It was holding momentum, was fighting, trying to keep price up. It's breaking down, looking like it's heading to 30. How about the MACD? You have a negative crossover. It couldn't do it. It was turning up, got rejected. It's heading lower. Again, looking like a break here. Could be technical disaster. How about momentum timer pro? Now notice the 1 month, no strength. How about the 3 month minimum, 6 month minimum? What is it telling you? It's telling you the Russell 2000's in a downtrend. So if you're trading this, so again, when a sell signal flips to a buy on the daily, keep it short. That is, on a downtrend, you don't want to take long positions. You want to be in and out. Yeah, you may be able to get a few days out, but don't lock in and hold. How about the bigger picture? Moving averages heading lower, momentum on lower, everything below the 100-day moving average. All the moving averages below that, momentum negative. This thing ugly. Let's take a look at IWM, and here we can see from a technical perspective, let's zoom out to the 2-year. You can see it's holding right here around 192. Boy, if this really breaks any lower, notice how there's no volume traded here. In fact, you don't start picking up volume until down here at 160. This is a problem. Again, you look at the 200-day moving average, it's heading lower. It's practically telling you the Russell 2000's in a bear market. Look at the 50-day, it's curving back down. The 100-day, it's got a nice downward slope. Even the 21-day is curving lower. We'll zoom out to the 5-year chart, and you can see major support isn't sitting down here until 154. So if this falls off a cliff, well, it's going to take the rest of the market with it. All right, let's take a look at junk bonds, which are pretty junky looking. How about the RSI? It's below 40. Momentum just couldn't get behind it. Price is breaking down to new lows here. How about the MACD? Well, nothing. It kind of wanted to try to bottom. Nope, it's heading down lower. Momentum timer pro, you'll find that out on Monday. And of course, we know price is bearish, momentum's bearish, just below everything. This chart is super ugly, suggesting liquidity crisis is actually coming. Here, check this out. We got to go out to the weeklies on this max weekly. Look at where we're at. We're at 79.26. There's almost like nothing left to hold this. The high yield bond market is about to blow off, and that is a major risk off move. You can see there's just a little bit of support down here at 77 going back to 2016, and then you've got down here 2011. There's not a lot left here before this thing blows out, and that could spell death of equities, at least for now. I'm Steve Van Metre. Thanks for watching. We'll see you in part 2. Bye.